What I find interesting is the last gasp in the private credit market seems to be reaching for bigger deals in AI. And Morgan Stanley put out a piece in November of last year suggesting that of the $1.5 trillion in external financing that the data center guys need to build out the infrastructure will come from private. So $750 billion will come from private credit. So it's a feedback loop. If the AI bubble pauses and the equity markets go down, then we start to have all the daisy chain effects. Then valuations go down, and then people start to question everything. And then if the NASDAQ goes down and people locked into their private credit funds, they start selling equities because they need to, rich people, need money. If they have 50 million in a private credit fund and they're getting 8 cents on the dollar back, and then easily, so it starts to have a feedback daisy chain effect. And that's what we saw during the great financial crisis. I was at BlackRock. I was on the equity side, but I'm a unique individual. I was a fixed income salesman for 5 years at HSBC. So when I was at BlackRock, I was talking to the bond guys all the time. And in '07, they were all hiding under their desks. And the equity guys were partying until November. And equity people, equity people are storytellers and they don't understand the credit markets. And that's why I was able to navigate, and my partner and I were able to navigate we lost money, but we lost less money than everybody else. My credit background led me to see what was going to happen to the equity markets eventually. I think the equity markets are late to the party as usual. Credit is starting to go the wrong way. PIMCO's told you that. We're starting to see the early signs. The flows have stopped. And what's more important about the private credit market is there's outflows, but are there new inflows? And if there are no new inflows, this whole engine of credit creation stops and is frozen. And that's all it really takes. It's a second derivative change. That's all you need.
Yeah. So let's, I know you probably saw this, was it earlier today? Amazon floated a junk bond, or not a junk bond, investment grade bond that didn't get, it was only 1.6 or 1.8 subscribed. So yeah, I think you're seeing the credit market overall get a little bit more cold feet. Let's talk about this in terms of equities. I know a lot of people have questions about that, and you're a great guy to turn to as somebody who's, I love the fact that you've got one foot in the bond market camp, because you're right, because the bond guys are always the ones who understand the fundamentals. But, the equity people are just as, the narrative and the story to tell to get it out to the public. That's an important part of it too. So it seems like, okay, if we get more of a credit market story emerging in AI, immediately people are going to ask that. They're going to say, okay, does that mean the bubble burst? Does that mean that stocks are going to plunge and go down? Are we going to see, a correction in semiconductors and AI stocks and the overall market stays up? Or, what is kind of the chain of progression that you're looking at if we do continue to get more of a credit cycle shift here?
Well, so, the equity market is right now, currently, it's around 40 to 45% AI or AI adjacent on a total market cap. And if you look at all the valuation metrics, we're back to absurd levels where if you do the math, a lot of people have said the same thing that I'm about to say. We did a free piece on this last year. 4 10-year returns at these valuation levels, including dividends, are 0% historically. So what does that imply? That implies a big drawdown between now and then. And I think the drawdown's, closer than it is further away.
Do you have you say big drawdown? We're talking, more than say a 20% technical bear market.
40 to 50%. And look, when you get to 50%, the math becomes onerous. Investment math on a drawdown, when you go down 50, you got to go up 100 to get your money back. So that's what you try to avoid, drawdowns like that. The semiconductor space at the peak, and it's already up quite a bit. I don't know if it's peaked yet. We'll have to see. We need more time and more structure. But the semiconductor industry is 19% of the S&P 500. Okay, I've been doing this a long time. Semiconductors are notoriously cyclical. They're boom and bust cycles. They've never not had a boom and bust cycle, and the drawdown is anywhere between 50 and 80% once the cycle bursts. And in the dot-com cycle, it was an 80% drawdown in the semiconductor industry. The Korean stock market is basically 2 semiconductor stocks, 50% of the market cap, and that's already down 30%. So I don't like to make market calls because honestly, I look at structure of the market. Calling a top is notoriously difficult. You don't know what top's in until you get about, 10 to 12 weeks of price structure. We don't have enough price structure to call a top. But when we do get the structure, I'll call it. But, we'll probably already be down 20, 25%. But this is the kind of thing we're looking to see. And if the only thing working is the AI, that I've seen this before, you concentrate into the last thing that's working. And why is that's the last thing that's working? Because the rest of the economy stinks. We know this. The unemployment numbers have been notoriously bogus for 2 years. Non-farm payroll numbers keep getting revised down. It's so bad that a report that my whole career I didn't know about. It's called the Quarterly Census of Earnings and Wages. It's the book report of the non-farm payroll. It's 9 months in arrears. We've never had to worry about it because non-farm payroll was never as far off as it has been. In 2024, it was 8 standard deviations wrong to the upside, the non-farm payroll. In 25, it was 4 standard deviations. And in 26, it continues to look wrong. So the employment situation in the U.S. is notoriously bad. You see that in the K-shaped economy. You see consumer delinquencies rising, auto delinquencies rising, and now we're starting to get the beginnings of foreclosure starting to rise. Very small, but it's starting. So the real economy is already problematic. And if we go back to what really started the private credit questions, it was the First Brands bankruptcy and the Tricolor Auto. Those were operating companies that were reliant on the small cash flow consumer guy. So you see, eventually, small cash flows of the lower part of the K-shaped economy affect the overall economy, and that's what we're seeing. The private credit markets really started to seize after those bankruptcies, and those aren't tech companies. Those are just First Brands is an aftermarkets auto company. Well, guess what? Joe Sixpack isn't doing well. Tricolor Auto blew up because that was giving money to immigrants to get loans, and Trump shut down the border. So this is how it begins. Little cash flows start to affect the credit markets, and here we are. And so now the last credit gas, the last impulse was AI, and I think that story is imploding as we speak. We'll see. I'm not calling the top, but it seems like we're seeing the end of the AI debt cycle, and we'll see what happens. But right now, it looks precarious.
Yeah, who was it? Abraham Lincoln said that prophecy or predictions is one of the least profitable enterprises or least profitable endeavors. You can never make a prediction about especially complex markets. But I think you're touching on something we talk about a lot here, which is the fundamental state of the real economy and how that drives everything. It just doesn't happen all at once. I think people get impatient. They think, okay, the labor market's been, as you said, we pointed this out too, the QCW is tremendously helpful for doing so. The economy's been in crap for a couple of years now. But because it's been in a couple of years, you get into that recency bias too. You think, well, okay, it's been crappy for a couple of years and nothing bad seems to have happened. Therefore, nothing bad can happen. But what you're saying, and I certainly agree with you, is that those fundamentals are working away on the inside, eroding the margins, eroding the capabilities of borrowers to pay back debt. And then you combine that with this is one of the things I really wanted to ask you about. What seemed to be a shocking level of just incompetence or no reason, nobody did any due diligence. Gunlat called it garbage lending, but we keep seeing this over and over again. So there was 2 major assumptions in private credit that seem to be being revealed right now, which is, okay, everybody bet on the economy being strong and resilient, which hasn't really turned out. And the other thing was everybody just pretended all the I's were dotted and the T's were crossed. The collateral was there. It was positioned. It was actually not duplicated or fraudulent. That was the biggest thing with First Brands. So it was those combination. Okay, the economy is worse than we thought. And nobody did their homework on these loans. It just seemed like everybody just piled on volume just for the sake of volume. And then one other part that you just touched on, which I really think we need to get into, is as the cycle started to shift, it kind of narrowed everybody's focus down to AI, which means we have even greater risk in the credit market, not just stock market, but in the credit market with everything concentrated on AI is sort of the last gasp. I know I hit you with a lot there, but fundamentals and then, lending standards.
Well, let's talk about the category. I wrote this in the short piece that I put on my Dowd Beyond the Narrative Substack. And again, I have a unique perspective. I was a large cap growth manager, and in my index, financials were a small part of our index because there's not a lot of growth financials.